Well, good evening, everybody, and welcome to the September 2023 Investing Roundtable. And no, that is not Devo on the slide there. That is the four of us. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing and a volunteer with the Mid-Michigan chapter of Better Investing. And I'm joined here by three very dear, close friends, all of whom that have demonstrated and experienced successful investing and stock selection. That's why they're here to share ideas with you tonight. On the left, and he's kind of doing his Benjamin Button thing there, Kevin Gologly from the Washington, D.C. / Baltimore area, and he's been around for a few of our presentations lately, so his voice is probably becoming quite familiar to all of you. Welcome, Kevin.
Welcome, and apologies to everyone who has to hear my voice.
All right, no apologies necessary, Kevin. We love you. All right, and again, I still think he's the magical mathematician from Mid-Michigan, our raconteur, Ken Kavula.
Hi, everybody. Glad to be with you this evening.
It's magnificent mathematician. You really know how to butcher a nickname. Magnificent mathematician from Mid-Michigan.
Okay. All right, I'll keep trying, I'm kind of like an old dog. And last but not least, a very special guest damsel. She's been with us a number of times. She is probably best known as a former groundhog champion and the most accurate stock picker amongst the knights and damsels of the round table for the last 13 years. So she hauled away a trophy last year. And Ann Manning from Houston, thank you for joining us.
It's nice to be here. Thanks for having me.
All right, so we're going to do some stuff here. Yes, quality is kind of a big deal around here, so we will be spending some time with some quality companies. The reason that graphic is there in the middle of the page is, again, quality flatlining. And now that's actually a zip lining image, because you go looking for flatlining, you get some stuff that's not quite as good. But when it comes to flatlining, a quality company that has an excellent rating, an excellent condition or characteristic that stays that way is a very desirable thing. All four of our companies resemble that quality characteristic you see in the middle of your page there. And the four companies are there on the right: Globus Medical, Diageo, Edwards Lifesciences, and Tractor Supply Company. So that's what we're going to be spending some time with here for a few minutes. Any comments or questions, Ken?
No, let's get this show on the road here, Mark, okay?
Okay, and we do that by issuing our standard disclaimer. No investment recommendation is intended. This is an educational demonstration. See a lot of familiar names in the audience, but if you're new and you were here for the first time, welcome. There is an audience poll towards the end. You are invited to vote, but this entire session is about the demonstration and illustration of some principles and methods / techniques used by the modern investment club movement. Whether it's NEIC Better Investing or Manifest Investing, we basically are interpreting the lessons learned over the last 8 decades and sharing them. That's the whole purpose of tonight's session. So you'll hear opinions from us and interpretations. Please do your own homework before making any investment decision. If we own something in a personal portfolio, we will try to remember to disclose that. If you'd like to be added to an email reminder list for this particular event, which is a monthly webcast, send a note to an email to nkavula1@comcast.net. If you have any other questions or you'd like copies of the slides, our 2 email addresses are there at the bottom of the page. Anything else, sir?
No, I think you did a nice job. I like the change that we've made in our a little bit of some of our disclaimers here. Maybe we'll make it in this disclaimer also. What was that one that we put in the bull session disclaimer, Mark? We're not in charge of you, or something like that.
We are not the boss of you, and you basically.
Right. Okay.
We actually do believe that everybody sitting here listening, first of all, you're special because you're here and you make decisions and you have discretion. So anything that when we talk about Value Line, we're not telling you to run out and go buy a Value Line or take a subscription to it, But you know what? If it makes sense for you, do it. So that's all we're here to basically say. All right, we do like to look back at our performance. Here's a quick summary. We've been doing this again since 2010. We do try to basically identify some opportunities to basically run through the gauntlet. We do actually actively welcome non-core selections for some reasons, but the most of the portfolio, again, 75, 80, 85% of the portfolio is going to be core investing. They're going to be very high quality generally, and that's what most of the holdings consist of. Our goal as a collective community going back to July 2010 is to build a portfolio which beats the market by 5 percentage points. That's what you see. That's what we mean by that relative return of 5% that you see down here at the bottom. So that's what we're after, and actually doing fairly well. We also want to see about 55% of the selections actually outperform mirroring investments in the market. So we're always comparing to that also. So the graphic just basically shows our relative return over time. Relative return is basically defined up here at the top of the page. It's the answer to the question, how much are you beating the market by? Our rate of return, thanks to the last few days of September, we actually were up pretty close to 16%, believe it or not, in August. And that is now at 14.9%. The Wilshire 5000 over that same period of time, 10.1. You subtract the 10.1 from the 14.9, you get a comparison or a relative return of 4.8%. That is also referred to by some investment professionals as alpha. All right, so the goal of most investment clubs is to come in and target that 5% threshold. There are no guarantees in this business. It's nice to get there. It's nice to hang around that area, but if you can come anywhere near that at all, you're actually doing pretty well. So we are, as you can see on the right-hand side of this, we are percolating right around that 5% level, and we'd like to actually see it go higher. Our outperformance has sagged just a tiny bit down to 49%.
It is amazing, Mark. It's amazing to read the original materials coming from Better Investing back in the 40s and 50s and hear them talk about stock market does an average of 10% over long periods of time.
Mm-hmm.
And our goal is 15%. And here we are after 13 years watching the market do 10% and watching us do 15%. It's just amazing that the methods that we're using do in fact seem to produce results if you use them thoughtfully and methodically, and if you have some patience behind your choices.
And the wow image down at the bottom is just simply an acknowledgement that that performance level compared against any institutional fund or anything like that would place in the top. I haven't run the numbers lately, but it would be at least in the top 2% of all actively managed funds. So it is kind of a wow moment, and it's been cool to participate in. All right. Just for a little more perspective on this, this is a chart that we do like to use. And Ken, look at the 10s down the middle of that page over here on the benchmark returns. He's basically looking at what we were just talking about for the investing roundtable. That's right here. We just wanted to give it some context versus a variety of different things, including a few stocks. And the stocks that are on this page are not an accident. Those are the most common or widely followed stocks, either in the Manifest Investing 40 or the BI Top 100. So those are very common holdings in people who are listening to this call. We have a couple of portfolios that we keep track of, the Tin Cup Demonstration and the Best Small Companies. Although we're taking it on the chin this year, our long-term performance is pretty strong. The widely followed companies is good, but then we also like to make the point that that is Indexville down at the bottom, and those numbers are all pretty close to 10%. So again, in context, pretty special to be operating at that 4.8, almost 5% relative return or comparison level. Good fun. All right. Here's a look at just a quick look at the portfolio to see what has actually caused those numbers, what's behind them. This is just the top 20 holdings of what now number about 80 active positions. You can actually reach the entire portfolio by going to the link on the right here, public link round table. But what you're looking at is the top 20 holdings by percent of total assets, ranging from Microsoft at 14.7 of total assets down to number 20 being Dow at 1.2. That's a relative newcomer. And the way that you read this page is anytime that we invest in and make a decision, whether it's by a knight, a damsel, or audience vote, we invest $1,000 into that company. So again, you've heard the story many times over. Microsoft has actually been selected 5 times. Here's Microsoft here. So $5,000 invested in Microsoft is now worth $80,000. That's a $75,000 gain. So a lot of fun, offsets any shortfalls in performance from other investments. And don't even think A2 Milk or Portillo's, Kevin, because they did.
I didn't say a word. I was thinking,
He was
things, but I
thinking
didn't
it.
say a word.
I was just heading you off at the pass. All right. Anything you want to add, Tim?
Yeah, I think what's kind of interesting, Mark, is that while everybody knows the Magnificent Seven, or at least have heard the talking heads speaking of the Magnificent Seven stocks that are really controlling a large part of the market recently, we don't rely on those stocks nearly as much as you might expect. I look at our best performers, and here's the second best performer, Booking.com, and you hardly ever hear about this stock, even though it's one of the largest companies of its kind in the world, does more bookings than all of the other booking companies put together, and you hardly ever hear of it. Cognizant Technology, Universal Display, MKS Instruments, EPAM Systems. Here's stocks that you just don't hear about, but our community is familiar with these stocks, and we've ridden them to some pretty spectacular gains over the 13 years that we've been putting this portfolio together. Just a note also that this is a tracking portfolio. That means it'll contain many, many more stocks than a traditional portfolio would hold. And we don't manage it nearly as closely as you would manage a 15 or 18 stock portfolio in a personal setting or a club setting. There is a difference between the two kinds of things, but we do try to have the same goals for what we're doing, and it just gives me a warm, fuzzy feeling whenever we come close to reaching those goals, as we did tonight again.
Yeah, we will sell a company if it really gets overextended and overbought, and also we'll sell it if the return forecast drops to a certain point. And we also have sold a few companies on degradation of quality. And just to hammer home the quality point, over here, anything color-coded in blue is in the top 20% of all companies. So excellent quality. You can see the vast majority of the positions meet that description, and the average actually checks in at 84.5. Our overall portfolio return forecast is a little bit light, but our growth, again, we want to aim for probably 12-ish, I would say 12 to 13% for the overall growth of the portfolio. That's actually top line growth forecast, sales growth forecast. And it's a weighted average. And we're actually doing pretty well there too. So it checks in pretty good across the board. We would like to see a little more par, but that can be elusive sometimes, especially in times when things are going pretty well. Anything else, Ken?
No, we're staying up with the questions. Sharon Saris, one of our friends from Northwest Buckeye chapter, was asking us, when do we weed and feed? And we'll do it right in front of you when we choose to drop a stock from the portfolio. And we look at a couple different things. I don't know if we're going to do it tonight. Mark, do you have a slide on weeding and feeding tonight?
We don't, because nobody met the criteria for, RSI greater than, we actually use 80 for relative strength index to trigger a selling evaluation. And pretty much like the lowest company I think that we have is Universal Display. And you'll have to pry that from our cold dead fingers, because we love that company. Not that we're emotionally attached, but that's still pretty close to money market rates for
Yes, it is.
Display. So again, very high quality
Yes,
company, considered undiscovered, but resembling a core investment. We say let that run.
We will look at non-core stocks that move below the MyPar number. MyPar is the average of the Manifest Investing database, and that number changes on a daily basis. I don't know, what's it, around 11 right now today, Mark?
Yeah,
something like that?
Yeah, right at 11.
Right at 11. Okay, so a stock that would move with a par, a non-core stock that would move with a par below 11 might be a candidate for us weeding out, but we are certainly open to making exceptions to that rule when we think that there's potential going on for what's happening. We won't get into core, non-core tonight, but Mid-Michigan chapter is going to be doing a series of workshops in the next year for beginners, for people that want to talk about specific kinds of subjects, and just for general kinds of interest. That'll be in addition to our roundtables, and we will send out information to our mailing list when we do these programs and invite you all to come. We're not going to charge anything for them. We're a nonprofit, and we believe nonprofits should be exactly that. If it doesn't cost us anything, then it shouldn't cost you anything to attend either. So we'll be keeping you informed as we put these programs on. We're looking right now at 3 separate times in the next 8 or 10 months. And we'll let you know what we're going to talk about, who's going to be talking, and when we're going to be doing the talking.
Sounds good. All right, so with that, I think we can go and get into our stock presentations. And we'll start with Tractor Supply and Ann Manning.
Okay, could you just back up to one slide just for a second?
Is it on that
I have
slide?
a reason. Yeah, no, I just wanted to go back up to that. Ken is always shouting out to people he knows.
Yeah.
And I just wanted to give a shout out to some ladies that Matt Spellman and I had the pleasure of meeting with last night here in Houston at their club meeting. They've been in existence for about 20 years, and they're called Women of Interest. And I see some of them are attending tonight. We told them about this, and they were very excited. They did not know about Manifest. So we're hoping that they will come in and join us, and we'll try to behave tonight so you'll want to. So anyway,
and
that's it.
If those ladies would send Natalie, my wife, an email, she'll put them on our guest list, and then we'll give them a reminder on a monthly basis, just that one single reminder that the roundtable's coming up and that they can click one link and register for the roundtable. So if they'll send Natalie an email, she'll help them get on our guest list.
I think they probably will. So
Great.
anyway, okay. All right, let's get started.
Okay, go ahead, Ann.
Okay. I chose Tractor Supply tonight. I did a stock screen. I got it down to 2 stocks. Tractor Supply was one, and Gentex was the other, and Tractor Supply won out. As you can see, they are celebrating their 85th year in business. They started out with a guy in Chicago starting a mail order tractor parts business in 1938. And 1939 is when they got their first store. And so they've kind of come full circle. They now have stores and online shopping. So I thought that was pretty neat. They used to be in Chicago. Their headquarters are in Nashville now, and they have been a public company since 1994. As you can see, they have over 2,100 tractor stores in 49 states. The only one I couldn't find store in was Alaska. And they are all company-owned stores. They do not have franchises. They are not trying to compete with Lowe's or Home Depot. They are a totally different store. They're a smaller store than those stores. And as you can see, they have about 15,500 square feet inside. And because of the types of things they sell, they have that much square footage outside for things that they are keep outside. A surprise to me is they also own a small pet store called Pet Sense. They have 192 stores in 25 states. They're mostly right now in the Southeast, but they are expanding. And if you go and look at their locations, they're kind of like Tractor Supply. They're mostly in smaller towns. For those of you who live in a city, you've probably never seen a Tractor Supply store because they're more out on the edges of the cities, going towards rural. And they try to go for what they call a recreational rancher or farmer. And when we get to what they sell, that'll make more sense. They do have 52,000 employees. And like I said, they're in Tennessee. Their CEO is Hal Lawton. He has done a wonderful job since he became CEO in 2020. And he has increased their sales, their net sales by 70%. Next slide. Their goal is to get 3,000 stores. And to do that, they're going to try to add about 90 stores per year. This year, they've added about 70 of the Tractor Supplies and 10 to 15 of the Pet Sense. Last year, they also purchased, and I will probably butcher this name, Orscheln Farm and Home Company for $320 million cash. And they are going to convert about half of those to Tractor Supply stores, and they've already got approval from FTC to sell the other stores to approved buyers. I was not able to find out who those buyers was that they're selling those to, but that will certainly help to compensate for the 320 million that they put out to buy this. They do are trying to invest about $250 million a year to grow the company, and they have an active buyback program for their shares. Next slide. This shows you the type of sales that they have. As you can see, it's not your typical hardware store. It's not a Lowe's or a Home Depot. They do sell things that most of those don't sell. I've asked Mark to have the website on the back so he can pull it up. And if you could do that now, Mark.
Okay. Let me go ahead and jump out. I had it up and running, but I think I closed it, so it has to come back. Here we go. I think this is what you had in mind, Ann.
Yeah, I think so. When you are on your SSG and you pull up their website, it actually goes to their online store. And if you want to go find out anything about their investor relations, you have to scroll down all the way to the bottom of the page, and you will see places where you can click on, and it will actually take you to an investor page, as you can see down here at the bottom. That's I found that interesting that you actually go to their website in terms of their online store, not their actual website. These are all the categories that they sell in their store. And let's click on, let me see here, Farm and Ranch, Mark. And if you'll go to that, you will understand why they're going for the recreational farmer or rancher. These are more small deals. This may not be their employment. This may be something they just do as part of, things they want to do. So they're not a big farm. They're not a big ranch. They may have some horses, some other livestock. It's mostly small acreage that these people have. If you go down a little bit more, Mark, keep going down a little bit. Okay, where you see farm and ranch, these are all the different, if you'll scroll down a little bit more, these are all the different things just in the farm and ranch category that they sell. Okay, this is only a 15,000, I mean, 5,000, is it 15,000, I think, square foot building. But they have a lot of this stuff sitting outside. And if you click on each one of these, it gives you another level. It shows you in each one of those the different products that they that they sell. So if you'll scroll back up and you'll see that is a lot of stuff that this company sells in these stores. So I invite you to go and look at each one of those. The funny thing to me is they're called Tractor Supply Company, but they don't sell tractors. They sell things that you pull behind the tractor to do your fields or whatever you need to do with that. But they do not actually sell tractors. The closest thing they sell to a tractor is a huge riding lawnmower. So there are two stores that are fairly near me because I guess I would be considered rural, even though I'm in a subdivision. And I don't think I've ever been by there that the parking lot wasn't full.
Wow.
So they're very, very, very well received for the type of things that they need, people need. They're the store to go to. They've got stuff that, pardon me?
Go ahead,
And this is Ken. I have a hand in the air, and Brenda Cornish. Brenda, if you'll unmute yourself, you can ask your question, Brenda. Brenda, you're self-muted. You'll have to unmute yourself if you want to ask a question. And if not, I'm going to assume it was an inadvertent hand, and we're going to continue.
Yes, that was a boo-boo.
It was a mistake. Okay, thanks, Brenda.
Mm-hmm.
Okay, go on, Ann.
Okay, but again, if you look at their online website, you will be surprised. I mean, they sell seasonal items like decorative items, or they sell bird seed. I mean, or they sell just your basic gardener supplies. I mean, they have wheelbarrows and they have tools to do just a garden. You don't have to be a small ranch or farm to shop there. And their pet scent stores kind of done along the same line as Tractor Supply. They're not trying to compete with a PetSmart. These are small size stores. A PetSmart, I think, is maybe about 15 to 18,000 square feet, whereas a Pet Sense is maybe about 5,000 square feet. So they're much smaller, but in the same deal, they're also located in small communities. So they're not competing against a PetSmart. And again, they are, going to try to expand those also. At the bull session today, Mark mentioned that they also sell guns. And we had a discussion about that. I couldn't find any real guns. What I found was air rifles or BB guns.
Okay.
So maybe I missed it. That's all I saw. So, and I also wanted to say, on the pets sense, they are a full service in terms of things that you can get. Now, the vet deal is only more like shots or microchipping, but they do offer training for dogs. They offer a service called WAG Services, and you sign up. It's an app, and you can sign up for somebody to come walk your dog. You can have drop-in visits during the day for potty time or playtime. They offer house sitting or dog training. So, you know, I mean, for people that don't have, if you are in a small community, you don't have a boarding deal for animals, this would be a big help to you.
Hmm.
Next slide. Okay, this is our value line. And Mark, if you want to take your trusty little red pen,
Sure.
this is a triple play. If you see over to the right, our projections are both in double digits for the annual return. Our PE ratio is definitely going from 24 to 22, so we have PE expansion. And our net profit margin is fairly steady across the board. So we do have a triple play here.
Okay.
The graph on the right will show you what is happened since 2000. I believe that's 2003.
3. Yeah, I just wanted to mention, because this really has a rich, better investing heritage. I think it was most recently featured in 2017 in Better Investing magazine, but I'm going all the way back to around the year 2000. And one of the guys that was on the Securities Review and Stock Selection Committee, fairly quiet guy, very studious. His name was Rick, and he came into a meeting sometime around the turn of the century. So the stock price would have been down around $2 a share, split adjusted. And he was just quite enthusiastic. And Don Danko and I came away from that lunch, basically said, we really probably should buy this one because he does not get that enthusiastic very often. So we have to take him seriously. And if we had, it would have been a really good run. So you can see from the price chart.
Well, in 2016, Ken actually presented this to the roundtable, and we kept it for about a year, and as you can see, it dropped. And that's been 6 years ago, so I don't remember what the discussion was, but we did sell it at a loss. Because at the time, that was probably the best thing too. We didn't know what was going to happen to it. But you can see since 2017 how it has gone up, and it has gone up significantly since 2020 when the CEO they have now has come on board. And it's also they're oversold at this point. They're let me see, I have here somewhere. Their RSI is about 33.5.
Yeah.
So they're oversold at this point.
Yeah, they've been kind of flat for a year and a half. Yep.
Mm-hmm. So anyway, okay, next slide. I put all this together Sunday, and I will tell you right now, I'm probably more conservative than I should have been on my estimates. Because in the last 10 years, as you can see, they've had historical growth of sales of 11.6. In the last 5 years, they've had a growth of 17.3. So I probably should have upped this, but I didn't. So you can go in yourself and look at this, and you might think maybe you might make that growth a little bit more. As you can see, they really weren't hurt by COVID. They did have a wide price range in 2020, but their overall sales and earnings and profits seem to be fine. So anyway, next slide. When I looked at the management, my only concern was their debt to capital. That's pretty high for me. But when you go and you find their interest coverage, a good interest coverage is 7 and above, and theirs is 35. So they're fine on covering their debt. So because of that, it didn't worry me. Their PE ratios are so consistent. I did not see any reason to change the high and low for my evaluations in section 4. So I kept them at their average for the last 5 years for both of those. And again, had my gross sales on the front been higher, then my earnings per share estimate also would have been higher. At this point, it comes out of hold, but it depends on the day that you're looking at this. Some days it's in the buy range, and some days it's just head over the hose. So I would suggest that you keep a watch on this. As you can see from the right, their operating margins have been creeping up since 2018-19. 2027 seems to be a little bit down in the projection, but overall they are pretty steady in their operating margin. And also, if you look at their PE, like I said, their PEs are pretty steady, and they seem to be the same going forth. Okay, next slide. Mark put this graph on the bottom, and this is for the last 10 years. And as you can see, the par is at the highest, projected par is at the highest it has been in the last 10 years. Okay, next slide. Okay, this is manifest analysis. As you can see, they do have their sales higher than what mine is. Again, I'm telling you, I should have made it higher. But I do think it is a reasonable number. I think between what my number came out and what manifest is coming out, that this would be something you should consider buying. And as you can see from the bottom, Barron's also thinks that this is a good deal. I mean, yes, Home Depot and Lowe's have been good to us, but this is a stock that I think could also be good to us. So that's my offer for the night. And I will tell you up front, guys, that I did some shameless promoting this night to solicit votes for tonight.
Oh man.
I'm just saying up front that I'm taking the cue from Mark and asking for votes up front.
Well, without getting too obnoxious, that's Kevin's day job, so we'll just go right to Kevin.
Okay. All right.
You know, I don't know
it.
why you're singling me out. Last month, Ken did backflips promoting his stock.
Yeah.
You know, he was like he became pretty much a cheerleader. I expected him to pull out his pom poms. So, pot, meet kettle.
Have you been around when he falls in love with the CEO during his presentation?
Oh yeah, I mean,
it's not
you know,
pretty.
yeah, I was gonna say, I guess Natalie just lets him go off and does that, you know.
Yeah, she just shakes her head.
Well, if we're going to be doing shameless promotion, I need to be able to give a shout out to, there's 6 or 7 of the people from the DC regional chapter that are in the audience, and several of them that have helped do our presentation. We do a monthly presentation on the first Monday of the month, and that will be this upcoming Monday. And so we'll be looking at the stocks that are featured in the BI magazine. So come and see us. I'll put in the chat window our Facebook page so you can sort of see the information in the registration. And like this, it's free. So let's look at Edward Lifesciences. You know, this is a company I've looked at numerous times. I've presented as a stock idea to both of my clubs, and I get the kibosh on it. So just to let you know. So let's go to the next slide and let's sort of talk a little bit about it. We did this book review of Arnold Bernard's, the founder of Value Line, and what he was looking at for long-term investing. And he had his top 10 quality stocks from 1959, and all but one of them are still around today. So Mark did this long-term investing looking out 25 years. And what I've done here with this screen over on Manifest is I've been trying to be able to sort of look at how can I sort of create that without necessarily using an RSI or what the par is, but rather just to sort of see where things are long term. So the rank, if you see the criteria that I have there, I just have 4 criteria. Rank, can you show them what rank is? It's going to be the quality and the par added up together. And so this is in the top 10% there. The core score, I've had that highlighted right there. That's the 3 right there. And normally to be a core score, you want to be 225. This one I made it a little bit higher, made it 250 out of a universe of 300. And then the others were to be able to get above average growth. And again, most people, may poo-poo 11% growth, but that's really, really good. And don't diminish that. I wanted to look at healthcare. And then I always like to sort of look at what Motley Fool, they tend to be a little bit friskier than us, and seeing if they're sort of looking forward on it. And of the 2 that I sort of came in there, and I see Ken's stock is in here tonight too, but I was sort of between ResMed and Edward Lifesciences, and we're going to do Edward Lifesciences, but that's sort of how I came about with this one. Next slide.
Cool.
So we again talked about this last month when I did Monster Beverage, and Mark was the one who pointed out from this book from the 80s that, again, be careful about selling these growth stocks. If it's a really good quality company, and we all tend, my clubs have done it, and I've done it personally, where, the thing does so well, you end up getting rid of it. And it's just like, because you end up getting impressed with the new shiny object, rather than saying, look, this is a good, solid company, and I shouldn't get away from it. So this is just a reminder of that. In this company, as all the ones on that screen sort of are, this is a consistent 10%er. So let's go to our next slide. I won't go into all the details, but basically all 3 of the ones that we tend to look at, Morningstar, CFRA, and Value Line, they all have different mechanics and stuff like that, but they all are generally really quite favorable on this. And this is a company that's in the S&P 500 that, as Mark was talking about with on the list of the stuff that's on the round table, this is one you may not have necessarily looked at or really sort of paid attention to. Even though it's in the S&P 500, it doesn't get the attention of the Magnificent Seven. And so let's go forward and look at the next slide. And, we also say purchase what you know, and guess what? I have one of their products in my chest right now. I had open heart surgery in 2018, and I have an angioplasty ring from there. And one of the things to keep in mind is the American Medical Association says that 32 million Americans have some kind of implanted medical device in them. That's 1/10 of the entire population. And the picture there are me and 2 guys that also had the exact same procedure from the exact same surgeon that we met on a Facebook group for people that were looking at. So there's Facebook groups for everything. And so we're playing sort of our medical device ID card bingo. Anyway, moving on, let's go to our next slide. And so what they did is they initially tried to do an artificial heart, a Lowell Edwards. He was a retired engineer that didn't want to retire, and he decided to tinker around at looking at stuff, and he wanted to do an artificial heart. He couldn't, but he ended up coming out with an artificial valve. And the first one is there over on the right there in 1958, and now the more current ones, like the one I have, is down below there. And there's a whole range of different things that they do beyond just artificial valves, and we'll talk about that as we go forward. Next slide. So a little bit about management. They were originally a privately held company, and then they were bought out, and then eventually, I forgot who bought them, and then Baxter bought them, and then Baxter held them for about 10 years, and then they spun them off again around 2001. And so the CEO that brought him out of the spinoff just retired at the age of 70. And so one of the things George Nicholson talked about on his SSGs is he'd like to put a star when the new management team came on board. So from here on forward, we're going to have new results because the new CEO, who was a longtime executive vice president as well as their general counsel, was in there. But some of the things to keep in mind: cardiovascular disease is the #1 death in the world, and it has the top spending in healthcare of all the diseases that go on there. This has a very, we can look at those lines and we can quibble, that yes, it's the pre-tax profit earnings are not really touching those lines perfectly, but they are really sort of that up straight and parallel without necessarily being perfect on the latter too. Great financial health, capital allocation is exemplary. It has a narrow moat, and that's basically because it's such a competitive environment. And we talked about this during the bull session. When you're using Morningstar, if you're using the wide moat, you have to have 20 years of above average metrics on return on equity and return on invested capital. So this is just 10 years. And so it's really competitive. And the ones that they compete with are Boston Scientific and Abbott Labs and Medtronic, not directly on all of them because they have different fields that they work on. And Ken showed us this on, I think, a ticker talk, where you just sort of can pull down all those stocks and zero in on the management comparison. And what I've done there is I put in the industry average, which is the medical devices, if you can sort of mark that over there on the right, Mark. So there's the averages right there. And what I've highlighted in the red box are the ones that are above the industry average. So just so you get a general idea, and if you look at it, Edward Lifesciences outperforms all three of them compared to the others. So this is what sort of gets me. One of the things that they do is they have to, because they have this narrow moat, they're constantly innovating. They have a lot of patents, and they spend 17.7% of their revenue goes to R&D. So they're constantly doing those things to manufacture and design new things. Next slide. And to look at the sort of overall market, Edward Lifesciences has 5.6 billion in sales, and that's the breakup. And if you look in the upper right-hand side, that TAVR, that's transcatheter aortic valve replacement. That's basically when people cannot necessarily have a surgical where they have a sternotomy and they have to go in through a catheter to be able to sort of fix it. Usually it's a stenosis, a tightening of the valve. And so that's basically where they've really sort of grown in the last 13, 14 years. And what they're really trying to do, and the new CEO comes out of the and that's the mitral valve and tricuspid valve replacement, is that's an area that they think can really grow. As you can see, the projections according to Edward Lifesciences, if you look at the screen capture I have from their presentation, is they think that's going to be a $5 billion market in 2028. And right now, if you do the math on the 2% that they have, they're only at about 100 million. So there's a great opportunity to grow and do the same thing that they did with the transcatheter aortic valve replacement. My stuff was the classic surgical, that's sort of staying the same as in the critical care are basically all the monitoring devices that they use to sort of keep track of things. And those two are pretty constant. But that's sort of where the growth is in this. So keep that in mind as you're taking a look at this. Let's go to our next slide. And there's a lot of trends that are going on in medical devices. And, I sort of like to look at sort of what the overall industry is doing. Here's if you get the slides from Mark, these are all these underlines are hyperlinks. So you can be able to go to these locations and be able to take a look at it. Now, again, the medical devices, it can be a range of things, not just cardiac. There, as you can see, they can be wearables, they can be their own Internet of Medical Things, and cybersecurity and stuff like that. But the whole idea that there's a lot more surgical stuff and medical devices being implanted. So this can be everything from meshes to artificial hips, shoulders, knees, whatever, are all the things that are going on. And this is sort of the overall market and where Edward Lifesciences is. Now, again, they just work on cardiac, but I just sort of wanted you to see sort of the overall theme that's going on in the medical device industry altogether. Let's go to our next slide. So I've been doing this the last couple of times. I don't want to go through all the steps of the SSG. I've submitted a first cut to Better Investing, so you'll be able to see all my rationale in here. But I wanted you to be able to see sort of the general thing. So I'm estimating future sales at 10.5 over on the left-hand side. I'm doing future earnings at 12. You can see where the current PE is and where the future PE is. You can see in the upper right, the evaluate management. Again, the middle one that's gold, that's the return on equity. But again, a return on equity that's 23% on a 5-year average, that's like quibbling over something doing really, really well. And on top of it, since they have a very, very low debt compared to their competitors, that's incredible. And again, that 2A, that pre-tax profit is far and above better than their competitors. So you can see I have this as a buy. I get it as 6-to-3 upside downside ratio. And just like Ken talks about, my total return over there at 16.8 is really close to what we see on Manifest. And that sort of confirms where we are in terms of this. I like to look, I know Mark's not a big fan of the relative value and projected relative value because it can be misapplied. But these relative values, again, if they're on sale, it's great as long as they're not a deep discount. So these are ones that, again, a high quality company like this doesn't normally come on sale. One of the reasons it's been dropped down is because there's been a backlog, not with them, but at hospitals in terms of staffing, because they need very specialized people to do these surgeries and to be able to do that. And in the post-COVID era, those things sort of slowed down. But again, they have a consistent record of being able to perform and do well. And this is sort of where I am and why I think these numbers, like Ann, I think maybe I was a little bit too cautious, but I think I'm still really quite in the reasonable range. Let's go to our next slide. So again, some more shameless promotion. We have a book club, and the person who runs it, Ann Bradley, is in the audience tonight. So I had to be able to make sure to let her know. I'm going to be looking at Adam Cecil's book, Where the Money Is, Value Investing in the Digital Age. It's a great book, easy read, former journalist, but he talks in the details that we like to sort of look at. So come see us on the third Tuesday of the month. That one will be in November, and that's my report. Thank you.
Kevin, I have a question from Randall Buss. And Randall, I'm going to unmute you and let you ask your question. Go ahead.
So I'm a heart surgeon, so I use these valves every day. The Edwards valves are very good, and they were the first one that came out with a TAVR valve. And the only competition currently is with Medtronic, who has what's called a core valve, and they're very similar valves. I disagree with a comment. There's plenty of heart surgeons and cardiologists put these valves in, and they say their sales are leveling off. That's just because they're so widely distributed in, and there's no lack of personnel to put these valves in. I will tell you that for 100%. The key thing going forward is the mitral and tricuspid valve. That's completely anatomically different type of structure. It will need a completely different type of valve. And you're right, whoever comes up with that valve first, and Edwards came up with the first TAVR valve, but whoever comes up the mitral and tricuspid valve out will be great, but experimentally, they're not working out quite yet. And it might be a few more years. So the key thing going forward with this company is who gets first with the mitral valve. I'll just leave that at that comment.
No, and I thanks for that information. And the other thing is because I'm not a scientist or stuff, I just learned this because I had the surgery. But you're right, the tricuspid valve, that's where their new CEO came from. He came from that division. So yes, that's where they're basically sort of targeting themselves for going for it. And yeah, my surgeon, he actually sold a product he was doing, the Harpoon, to Edward Lifesciences. He uses nothing but Edwards in his valve, and he does nothing but mine, a mitral valve repair. I had an angioplasty ring. That's it.
All right, thank you.
Any other questions?
No, Kevin, thank you so much. Appreciate it.
All right, thanks, Ken. All right, I'm just going to spend a couple minutes and then we'll move to Ken. I just wanted to share with the audience that one of the things that we've done here over the last few days is run through this series of our favorite screens as I work to try to find an opportunity to talk about tonight. Just very quickly, these are some of the more reliable screens starting up at the very top. It's not the only condition, but when you have a low relative strength index, and there are a number of companies down below 20, not just below 30, but below 20 now, you can have a situation that merits further study. So it is just one symptom, but it is a fairly rewarding, historically rewarding field of opportunity. So something to think about. We'll always look for our top companies that have high return forecast and quality. That's what Kevin was showing you, limited to one sector. And we talked a little bit this afternoon about the better investing small company predefined screen. Would highly recommend that as you search for companies. We will be using that extensively between now and Halloween when we make our best small company selections. Then we took a quick look at some of the low price to fair value opportunities at Morningstar. But we spent a few moments this afternoon on quality through the eyes of Jeremy Grantham. And Grantham was recently on Josh Brown's podcast, and I spent several minutes talking about quality, speaking very much the same language that we think as we talk about companies and quality. And that led me to this expression of quality, a product that has been in place for many, many years. And you got to like the motto there. And I thought I might do a little field research here with some Guinness. And field research is important. And my wife likes Bailey's. So this is really a product that we can relate to quite well. So there you go. There you have it. Here's where that actually comes from.
It'll help you wash down a Portillo's.
You betcha, baby. Yeah, and if when I eat enough Portillo's, I'll need Dr. Boss. Not good. Anyhow, Jeremy Grantham has for many decades run a quality, actively managed fund known as GMO Quality 6, and the ticker is right there, GQLOX. The fascinating thing about this is it's an example of the type of institutional fund where they know what they're doing. They have achieved a 13.4% return versus the market. So there's that comparison or relative return. Positive 2.1% puts them in a nice area, high quality. So what I will do is just typically, and we've demonstrated this for a number of funds. One of our other favorites is Brown Small Company. And the intent is basically to find somebody who knows what they're doing and look over their shoulders. So in this case, we actually are diving into the holdings of this GMO quality fund, just looking to see, is there any company that they have deemed to be of high quality, superior quality, that they're actually accumulating or buying at this time. So you can see some of these actually go back, as Ken pointed out this afternoon, their American Express goes back to 2016. There are a number of companies. This is actually companies 31 through 40. There's only 42 of them in the fund. But this one goes back to 2016. There's a number that actually go all the way back into the 2000 to 2010 timeframe. But what we notice here is the accumulation of these two companies, General Electric, which we recently put in the electrification portfolio, and this company, which makes the product which I'm currently testing, doing my field research on right now, Diageo, ticker symbol DEO. So this can be a way to mine for opportunities for study. It's a form of screening that we really enjoy. And here's something that I rarely do, and in fact, I encourage people not to do this. It actually was recently added to Berkshire Hathaway's portfolio within the last quarter. So anytime they get interested in something, it can be something to look at. The caveat or caveat emptor here would be, if it's being written about as something that Berkshire Hathaway or Warren Buffett, I'm doing air quotes, Ken, has been buying, you might be too late, because once it's actually all over the news, the price may be up. But in this case, the stock price is down to about 150 today, and Berkshire Hathaway within the last quarter or so actually paid 173. So again, we have a situation where if they liked it at 173, maybe we really like it at 150. And the other catch here is the Markel Asset Management Fund, Markel Gainer, is actually the largest shareholder in this company with a whole bunch of shares. And this is an accomplished money manager managing the assets / float of the Markel Insurance Company. So if you want more on that, you can actually look at that quote at the bottom. Here's some of the problem. Like many companies, and you're going to see another one with Ken here shortly, some of the companies are just caught in a downdraft. In this case, Diageo actually peaked above 200 early last year or late last year, and now they're back down to almost 150. And you can see that the relative strength index has actually done a deep dive down into the low 20s. So they had that situation back here to the left a few months ago, and it's continued. It's persisted. Here's a longer term look. Same situation, although we're looking at a longer term relative strength index, so it's still a little bit high, but it is at multi-year lows in terms of this 12-month trailing RSI, which is very different than most people look at. But the longer term picture here, and the thing that I think really matters, again, Buffett's getting interested in this company, somewhere in this time frame. Well, it's come down quite a bit. To me, the thing that matters more on this page is this blue. That's a trailing 12-month. It's actually a trailing 5-year moving average. And I just find it interesting that it's come down and touched that, and could be better days ahead. Assuming
Mark, I'm gonna interrupt and let Susan Zaleski ask her question, okay?
Hey.
Susan, you'll have to unmute yourself in order to ask your question. Susan, if you don't self-mute, I'm going to assume it's an inadvertent hand, and I'm going to continue the program. Okay, continue, Mark.
Okay, so again, longer term, it's basically at that trailing 5-year average. I find that kind of compelling, and again, it's just another way of thinking of a precedented price drop. So something to look at. So here is the company. You are looking at 7 to 8% growth, $20 billion company growing at 7 to 8%. Notice that value line is actually checked in at 10% for the current company. Looking at this picture right here, things are looking pretty good there. So anywhere from 7, 8, maybe 10%. The projected margins are solid as a rock. They are always 20, 22, 23, right in that range. So I'm very comfortable with the analyst consensus forecast checking in at 23.3. Again, a very normal PE for the company of 20, delivers a company that has a 12%-ish projected annual return. We do like to see the projected return on value confirming that. And as Ann also pointed out, we have this situation where that return forecast is at a multi-year high. And it's the type of company, this is a staple, a product which many of us understand. And this Guinness is quite good, by the way. It's just basically a situation where this type of return forecast is not seen commonly, and it could be an opportunity. So I'm going to go ahead and add this beverage situation to our tracking portfolio. And turn it over to Ken.
Thank you, Mark. This is the slide that you see at the beginning when you go to the investor relations page of Globus Medical, ticker GMED. Globus has just recently, on September 1st, completed a merger with NuVasive, and some of you might be familiar with the company NuVasive. Both of these companies are in orthopedic implants. They deal with all the different kinds of doodahs that surgeons can plant in the body to fix skeletal issues. That's a pretty broad-ranging list of items, and if you're interested in the complete list and what they look like, I would urge you to go to the Globus Medical Investor Relations page, and you'll get a really good investor presentation, which, among other things, will show you on the body exactly where all these different implants can go. For now, let's just understand that both of these companies and the newly formed company do orthopedic implants. That's what they make, and they support all of that by training doctors, by offering different tools to help place these things in different parts of the body, and by doing all of the services you might expect a company like this to do to support the implants that they actually make. Next slide, Mark. please. Here's the growth in the company, and we're looking at the two different companies. You can see that we basically had two great growth companies, which on September 1st became a single growth company. That means that most of the data that we're going to look at is talking about Globus Medical prior to the merger. And as you study this company, you're going to have to remember that. You're going to have to remember that they've taken on a partner, a merged company, and a lot of the dynamics of what's going on number-wise are going to change. The pictures are just pictures of some of the things that they will implant or use to implant different things into the skeletal system. Next slide. It's a huge market, $50 billion total addressable market, and you can see it broken down by Globus. Most of the market talks about joints. You might expect, many of you know people that have new knees and that have put in different helpers in different joints to help them move more successfully, new hips. I was surprised at the amount of different implants and the different things that can go into the spine area. That's a quarter of the business. And then you can see smaller portions in trauma, power tools to help make the implants, and technology which will enable the implant to succeed. Next slide. The two companies together did not cover the entire dark blue portion of the map. There was overlap, especially in North America and Europe, but now with with Nuvasis being a part of Globus Medical, we have great coverage over most of the globe. Notice that they have basically stayed out of China. The kinds of things that they're using are not being used by Chinese medicine for the most part. I do find it heartening that they haven't given up on population growth, however, and they have moved to the most populous country in the world, which is no longer China, but India. And they have a pretty decent presence in India, and that presence is growing faster than the businesses in the United States and Europe. Also, most of South America and the Asia Pacific region is pretty well represented down in Southeast Asia, down there towards Australia. Africa is still a big white space. China and Russia are still big white spaces. And there's a lot of white space in Eastern Europe yet to fill as well. Next slide. They're leaders in spinal surgery, navigation, imaging, robotics. They're leading. They're building a foundation in trauma where you have to do something quickly because of accident or crime or whatever else it happens to be. We all understand the word trauma. And they're moving into other musculoskeletal areas, including regenerative biologics. Regenerative is that magic idea where we can regrow something or grow something in another media and then use it for a human being. We've heard about them. It made big press when 3D printing hit the wires 8 or 10 years ago, and it continues to be one of the holy grails of medicine, to be able to grow new parts and then use them to replace defective parts. Next slide. This is the thumbnail right from your SSG Plus that I've blown up. You can read it as easily as I can. Again, the vast majority of the company's revenue prior to the merger came from the musculoskeletal solutions products. More than half of the revenue coming from the US. NuVasive has offered more products, more varied products, and an expanded geography to the company. Again, the graph, you're looking at a graph and you're looking at Morningstar forecasts that are based on the old Globus Medical. This is pre-merger. The merger only occurred a month ago, and based on the growth that we had seen in NuVasive and based on the growth that we had seen in Globus Medical, the historical growth, I'm estimating future growth at about 10% in sales and 11% in earnings. Value Line makes it quite clear in the commentary that its numbers will be changing as soon as the merger closes. That was from a value line that was about 2 months old. So I expect the next time I read a value line on this company, I expect that I'm going to see completely new numbers, completely new forecasts, completely new estimates. NuVasive, folks, was not a small merger. It was a large company merging into another large or fairly large company. They were both classified as either very large small companies or very small medium companies, and now we have a really good sized medium company in the medical devices industry in the healthcare sector. Notice the financial grade of A. Company's been around for a long time and has a good solid balance sheet. Next slide. Here's from the bottom of the first tab on your SSG Plus, and there's that 10 and 11% that I'm forecasting as growth into the future. I don't know if I'm conservative right there or if I'm right on the money. I don't think that I'm aggressive in using those values. I might be a little bit conservative when we finally see how NuVasive impacts the bottom line. Globus was quite adamant in the fact that the NuVasive merger would immediately become accretive to the company's bottom line. What that means in simple English is they're going to make more money, and it's going to come from the expanded manufacturing that they've just gained by taking up NuVasive's 50,000 square foot manufacturing facility, and by bringing in the products that NuVasive has that Globus didn't have. You see pre-tax profit on sales, which are pretty decent, but we would have to compare them to competitors. I'm not willing to do that with these numbers right now because, again, these are historical numbers for a company that doesn't exist in its same form anymore. Same for return on equity, same for debt to capital. I'm certain that the 2023 debt to capital will not be zero because I know that there were some funds paid to make the merger finally happen. It's all historical in all of this stuff up here, and a new company started on September 1st. I can't emphasize that too much. Next slide, please. It appears that when the merger was announced, and then as it happened, investors were not happy with the price that was paid by Globus for NuVasive. Notice that today, this is yesterday's prices, Globus Medical closed at just over $50. and the 52-week low is just under $49. A 52-week high had been as high as $80. And when the value line came out about 2 months plus ago, the price was around $60. So we're looking at what I feel is an overreaction by an investing public that, first of all, it's not a widely followed stock. It's not a stock that a lot of folks are familiar with. And I don't think a lot of people took the time to analyze what might be going on with the merger. They heard somebody was selling and they sold right along with it. I also noticed that the entire medical device industry is in a real slump as far as stock price is concerned right now. And I think we're going to have a picture of that to show you. There it is. I'm sorry. This is an ETF that measures U.S. medical devices called IHI. And you can see the slump going from the middle of July down to the end of September. Quite a dramatic decline in price for the entire medical device industry. And the graph for Globus, and can we see that one? Is that one the next picture, Mark?
Well, it's actually the area, the green area behind.
Okay, the green area behind is the price for Globus. And except for a little bit of a pop when the merger was announced, some people like to buy into that sort of thing, but the price turned right around after a small pop in the middle of September and went right back down and followed pretty closely what the ETF is doing. Notice that the ETF right now has a RSI of under 30. They're down to 13.58, and that's significantly oversold. I think you'll find that Globus is also exhibiting an oversold characteristic right now. I saw we had a question on what does the word oversold mean. Think of it as just a possible buying opportunity. It might be priced lower than it should be. It might be on sale. That's all it means when we use that analyst word oversold. My SSG assumed high PEs at around 34 and low PEs at around averaging of 20. No dividends being paid. My analysis when I finished was not as optimistic as manifests. I figured somewhere between around 13 and 18% for return. Manifest was at 19. I get a little bit of validation, but not as much as I usually get. I'm coming in on the conservative side of this. My numbers seem to be lower than the data coming from Y charts, which is what manifest numbers are based on. But next slide, please, Mark. I think that if my thesis of investors overreacting to the merger stands, then I think my analysis is pretty decent. And I think that I probably run the risk of getting a return up near the top end, up near the 18%, 19% that manifest says. Even Value Line is suggesting that 18% might be a good high-end number. If my thesis is not correct and there's a more fundamental underlying reason for the pessimism, then I'm still thinking that my low number of around 13% is realistic. I think it's probably more realistic than the 6, which was attached to just the company Globus. Remember that this box that I captured, the Value Line box that I captured, was from a 2-month plus old Value Line. And the old Value Line showed the stock trading around 60. GMed's actually trading around 50. So that's $10 on a $50 stock right there, just to go back to where the value line itself was. The capture on the right is from Morningstar, and Morningstar also suggests that fair value for the company is probably somewhere around 71 or so. And the last price again was around $50. Well, a $20 plus gain on a $50 stock, that's a pretty decent gain if I'm looking in the next 12 to 18 months. Value Line thinks it's undervalued. Morningstar thinks it's undervalued. I think it's extremely undervalued. And that's the play that I'm making about GMed. I will watch this stock closely, however, as the new numbers come out and I start to see the impact of NuVasive on the GMed, the Globus Medical company. As a final comment, I belong to a club that held Globus Medical on its pounce list for almost 6 years, never finding it in the buy zone, and finally dropped it from its pounce list because we just could not come close to finding it in the buy. Here we are about 3 years after we dropped it from the pounce list, and it seems to me at least to be quite a tantalizing buy at the moment.
Okay, and we talked about this afternoon at Bull Session about, I think this is and we committed to do it. Couple weeks from now, because we're going to do a different subject next week, but a couple weeks from now, hopefully with the new information, Ken, I'd like to look at a case study of, what did they pay for NuVasive? Did it seem like they were paying too much? On a first glance, we didn't think so. So I think it'd be interesting to look at that. The other thing that I think will be interesting, because of this special case, I had no idea NuVasive was actually, it has more revenues than Globus.
Yeah.
So it's quite a merger. It'll be interesting to see how much pro forma they do and actually try to recreate that company, in the rearview mirror. So
Globus characterizes this as a merger of equals, but I think that the twins are fraternal twins, not identical twins. Okay.
All right. Well, so we'll take a look
There's
at
a
the case
question
study.
in the audience for you, Ken. It's from Nick, and he was saying, was there any debt used with this merger? And if so, do you know how it impacts that debt to capital? Because that usually takes about a year to sort of show up on the SSG.
Remember that going into the merger, Globus had no debt. Okay, so I can't come up with numbers that for certain tell me what was being used until I get this quarter's report. And this quarter's report isn't, the numbers aren't there for me yet. So I probably can get numbers from someplace that I don't normally go if I can dig into the merger. But to be honest, I'm not interested in taking quite that deep a dive at the present time.
Yeah, we'll take a look at that capital aspect as part of the case study.
I do know that they offered seats on their board to NuVasive, and that they offered stock, a significant amount of Globus stock to the old NuVasive shareholders. There appeared to be some dilution going on, and that might have been part of the issue as well. I just can't parse that out at the moment. Okay.
Thank you.
Thanks, guys.
We do have a hand in the air that I'm going to honor. Tom Booth. Tom, you'll have to unmute yourself if you want to ask your question. Go ahead.
I'm just curious, how does Globus Medical compare with Stryker, since they're both in the implant business, size-wise and growth-wise?
I think I don't want to appear flip, Tom, but I think that's something that almost all of you can find an answer to. I don't know if that's really germane to what I was presenting tonight, so I didn't bother to look at peers for this. I'm telling you that I think Globus is significantly undervalued right now, and that's based on the fact of what I see just in that company. I don't know how it compares to Stryker, but I don't think that would be a very difficult thing to find out. I think I'm guessing that Stryker is a much larger company, but I also know that Stryker is not pure implant devices and associated things. They also have a very large
Right.
business in equipment, hospital equipment.
And we have another question from William. He wanted to ask each of the presenters if they actually own the stock that they presented.
The answer for me is no.
Oh, I own at least one can of Guinness, or at least it was a can.
Mark had a half a can of Guinness, so no stock. How about you, Kevin, for Edwards?
I did own it. I've sold it. I've been trying to find a time to get back in, and I feel like it's a time now.
Okay, and Ann, do you own Tractor Supply?
No, I do not.
Okay. We'll get some more questions, and folks, we have a fair number of questions in the questions box. Mark and I hope Ann and Kevin will stay after we close everything and try to answer as many of the questions as we can. But right now, we'd like to launch our poll. So let me select the right poll. Here it is, and let me launch it. And we'd like to find out which one of these 4 companies you think we should add a second position in. We're going to be adding $1,000 for each of the top 4 companies there. And then we'll add another 1,000 for the audience on the one that you give the highest vote to.
It's a pretty close race.
Yeah, we'd like to have 80, 85, 90% of you voting. We're up to 70%. So doesn't cost you anything, folks. Just get in there and use your mouse, or if you have a touch screen, you can even do it with your finger. Is it
too late for me to campaign that Diageo does represent the 4 major food groups?
Are you going to visit everybody and give them Guinness? Is that what you're going to do, Mark?
And make sure to give them some Portillos as well.
87%. I'm going to count to 10 backwards in my mind, and then I'm going to close the poll. Let's see if you can push it over 90 while I'm counting backwards here.
Well, with your Diageo and your Portillos, you can then go over and get yourself something from Edwards.
We had 88% of our audience voting, and here's the results.
Wow. That's as close as I've ever seen. Very interesting. Did we lose you, Ken?
No, I'm still here. Do you want to put one in for all 3 of the middle ones, Mark?
Yeah, I think so. You guys left out Diageo though, and I'm hurt.
Okay.
Mark is right. Drown your sorrows.
It's usually a clear winner, but we're in a pretty tight race here. So we'll say the audience chose 3 stocks tonight that they really liked, and we'll put in an extra $1,000 for those 3 right there and see what happens.
It's also a very defiant moment from this community that we're investing hard into a dropping market. So I hope we're right. All right.
This is just a placeholder that people are looking at right now, Mark.
Yep.
There we go.
Just a quick reminder that we do archive all of these presentations. The bull sessions and the roundtables can be found on YouTube under the Manifest Investing channel. And you heard Kevin mention a couple of those sessions. Hugh did a nice session down there on the lower right, second one from the right, on the FDA pipelines. And we honored Betty Sinek and the Bridgetown Ladies in that one, second one from the right on the top. And then we talked about paper boys in Chicago, Cleveland, and Northwestern Illinois in that bull session on September 5th. So good, clean fun. All right, some of our upcoming activities. Our October roundtable will actually take place in November. We're looking at November 1st for that date, and we'll also do a best small company presentation as part of that. Did I get that right, Ken, or did I botch that?
Yes, you had. No, you didn't botch it at all. That's good, Mark.
Okay,
Okay.
so let's do it together. Ken and I will be in New Orleans on November 4th. And the November roundtable is just after Thanksgiving, I believe. Or is that before? Anyhow, it's November 28th, I believe.
It's the Wednesday. It's the Tuesday after Thanksgiving. Uh-huh.
Tuesday after Thanksgiving. And then we have a couple of events. The dates may not be 100% chiseled into stone, but they're close. Just a couple of events that we want you to start being aware of. The details are to follow, but they will be online events. One focusing on beginners and getting started in investing, and the second kind of a revisit of the COVID cancellation conferences that we did over the last couple of years. Hopefully we won't have a COVID-driven need for that, but we did have a number of fairly good presentations on successful investing. So that's in April coming. Anything else that needs to be added to that, Ken?
No, I'd like to thank our audience for coming tonight, and we're going to say good night. I want to thank Ann Manning from Houston and Kevin Galagli from Maryland for helping us out. It's great to be able to count on some of our extra folks when our regulars are unable to make the roundtable. I want to give a special thanks to Herb Lemkool, who's been in the back room here offering us encouragement and guidance and occasionally answering a question on the question box here. And with that, we're going to close the roundtable recording, but we are going to stick around and answer some of the questions that you have. So, Mark, if you want to press that recording button, and we'll go on then, okay?
All right. Thanks, everybody.